We have crossed a line that markets rarely approach and almost never survive intact. For years, analysts warned that the silver market was being held in an unnatural state, restrained by mechanisms that could not last forever. Those warnings were dismissed, delayed, and ignored. But when artificial pressure finally gives way, it does not unwind slowly. It releases all at once. That release arrived today. On Saturday, December 27th, the structure supporting the silver market didn't weaken, it collapsed outright. During the electronic session, silver surged to approximately $79.25 an ounce, marking an extraordinary single-day gain of over $7. That translates to a move exceeding 10% in less than 24 hours. Moves of this magnitude do not occur in stable markets. A 10% jump is not enthusiasm or optimism, it is distress. It signals forced action, not voluntary trading. What unfolded was not a rally driven by confidence, but a liquidation driven by failure. Somewhere within the system, a major participant was overwhelmed and removed. When a large short position collapses, logic disappears. The entity on the losing side is no longer making decisions. It is being liquidated by automation. Positions are closed at any available price without regard to charts, valuations, or cost. During this process, buying becomes indiscriminate and relentless, consuming all available offers. This event occurred during one of the least liquid periods of the year, a time when markets are thin and sellers are scarce. With no meaningful resistance, the price did not rise step by step, it leapt. The chart did not curve upward, it shot straight up, reflecting the sudden absence of supply and the urgency of forced demand. Silver now sits at the edge of the $80 threshold, a level that carries psychological and systemic weight. What we are witnessing is not a routine market fluctuation, but the opening act of a broader repricing. The rules that governed this market for decades are no longer functioning, and the consequences are only beginning to unfold. To understand why this move was so violent, you have to understand what happens when markets stop negotiating. Under normal conditions, buyers and sellers slowly converge on a price. There is hesitation, counteroffers, and balance. But when forced liquidation begins, that process disappears entirely. At that point, control shifts to the clearing system. Computers take over accounts that can no longer meet their obligations, and the instructions are simple and unforgiving. Exit everything immediately. Price becomes irrelevant. The only objective is speed. Every available offer is lifted until the position is gone. That result appears on the chart as a near vertical move. That straight line is not excitement, it is damage. It represents the moment a large market participant failed and the system absorbed the shock. The surge in volume and the instantaneous price change confirm that this was not retail activity but institutional collapse. This is the point where theory turns into reality. What was once dismissed as a hypothetical short squeeze is now unfolding as a systemic event. Smaller players were eliminated first, followed by private funds and family offices. Now the pressure has moved up the chain toward major institutions. A 10% surge in silver is not just about metal trading hands. It reflects a broader shift in how value is being measured. When investors rush into a monetary asset this aggressively, it signals declining confidence in the currency used to price it. The move is as much about escaping risk as it is about seeking profit. Gold provides the context. While silver was exploding higher, gold was already holding above $4,500, a level once considered unthinkable. That price confirms the message silver is sending. Trust in fiat valuation is eroding in real time. Historically, gold leads and silver follows. When gold establishes a new regime, silver eventually accelerates to catch up. By long-term ratios, silver remains far below where it would trade if priced consistently with gold. That gap is now closing, and the force behind it is growing. Algorithmic systems recognize this imbalance instantly. They compare gold at record highs to silver still lagging behind inflation-adjusted levels and respond accordingly. Capital floods into the one asset that has not yet fully reset to the new monetary reality, intensifying the move. The sudden vertical rise may feel unsettling, but that discomfort comes from years of suppression and controlled pricing. Markets moving freely are rarely smooth. What looks chaotic is often the process of release, and silver is now moving without restraint. Attention now shifts to the weekend, a period that is normally quiet but suddenly loaded with risk. Trading screens may be frozen, but information is not. While prices remain locked, speculation, fear, and rumor are accelerating beneath the surface. As markets closed with silver near $79, the news cycle did not slow down. Reports of financial strain, whispered failures, and settlement concerns began circulating almost immediately. Whether confirmed or not, these stories apply intense psychological pressure to anyone exposed through paper instruments rather than physical ownership. Holders of derivatives and exchange-based products are now facing a question that cannot be answered until trading reopens. Will the system even function as expected when it reopens? Uncertainty around counterparty solvency is enough to force capital to move, regardless of price. That capital is already migrating toward physical metal. Across the retail market, dealers are struggling to keep pace. Inventories are being pulled, pricing is being suspended, and automated systems are failing to adjust quickly enough to the speed of the move. When sellers can no longer confidently quote prices, it reflects a deeper problem. The metal is not just rising, it is becoming difficult to source. In this environment, the displayed spot price loses relevance, replaced by a real-world cost that reflects scarcity rather than screens. Buyers attempting to secure silver now face premiums that far exceed the quoted market value. Coins and bars are trading well above official pricing, and availability is inconsistent at best. This widening gap between paper and physical markets is a hallmark of monetary stress. A market where goods cannot be purchased at the advertised price is not functioning normally. It is a signal that confidence in the pricing mechanism itself is eroding. What we are witnessing is not simply volatility, but the early stages of a currency credibility problem. As the weekend progresses, this pressure continues to build. By the time trading resumes, demand will not be starting from zero, it will be releasing from compression. The longer the pause, the greater the force when the market reopens. As trading prepares to resume, attention turns to the rules that govern extreme price movement. Futures exchanges are designed with emergency brakes, mechanisms meant to slow markets when volatility exceeds predefined limits. These safeguards are rarely triggered, but silver is now approaching the conditions that activate them. If prices jump too far, too fast when the market opens, trading can be halted almost immediately. Orders are frozen, liquidity disappears, and participants are forced to wait while losses continue to mount on paper. This is not a pause for stability, it is a pause that magnifies fear. For those holding short positions, this scenario is devastating. Losses cannot be closed, hedges cannot be adjusted, and exits are locked. Each halted session increases the probability that the next reopening will occur at even higher prices, compounding the damage. This is how markets become trapped in upward spirals. With sellers gone and buyers desperate, price limits can remain engaged for multiple sessions. History has shown that once this process begins, it is difficult to stop without significant intervention. The risk does not end with traders. Clearing institutions sit at the center of every futures transaction, guaranteeing performance on both sides. When one participant fails to meet margin requirements, the clearing system absorbs the shock until it cannot. If losses exceed the resources of the defaulting party, the burden shifts to shared protection funds financed by other members of the exchange. This transforms an individual failure into a collective problem, spreading stress throughout the financial network. As confidence in counterparties weakens, liquidity dries up. Banks and trading firms begin to pull back, not because they want to, but because they can't assess who is exposed. This hesitation can ripple outward, tightening credit conditions far beyond the silver market itself. In such an environment, official intervention becomes more likely. Central authorities may step in to stabilize institutions, often by expanding liquidity. But those actions carry consequences, reinforcing the very conditions that drove investors toward hard assets in the first place. While financial institutions struggle to manage exposure, industrial users of silver are reacting in a different way. For manufacturers, the issue isn't price appreciation, it's access. A sudden surge like this raises a more dangerous question: will the metal be available at all? Companies that rely on silver for production can't afford supply interruptions. When volatility accelerates, traditional suppliers hesitate, contracts are reevaluated, and deliveries are delayed. In fast-moving markets, reliability disappears before inventory does. Faced with that uncertainty, industrial buyers move aggressively. Instead of waiting for public exchanges to stabilize, they pursue direct agreements with producers, paying premiums to secure guaranteed delivery. Price becomes secondary